Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. In Japan, equities are trading lower as the market looks ahead to Friday's rate decision from the BOJ. Governor Ueda is widely expected to raise the policy rate to the highest level in 3 decades. That would be a 25 basis point hike, which would bring the policy rate to 75 basis points. In the States, equities edged lower, and the moves were somewhat subdued in front of a couple of key data points. Tuesday, we'll get the employment reports, plural, for October and November. We'll also get data on retail sales. That's where we start the conversation with Isaac Poole. He is the CIO at Ascalon Capital. Isaac spoke with Bloomberg TV host Sherry An and Avril Hong.
Talk to us about what you are positioning for this week and the extent in which you're putting weight on the data.
I think that the data is still very important, albeit a bit stale in some senses, but we will start to get an idea of just how quickly the US labour market is slowing. I think the trend there is very clear. It's showing up in the private sector data, and to the extent that it surprises to the downside, I think there's a real risk there that equities, which have really been banking on a big re-acceleration in earnings and growth, could just be wrong-sided and wrong-footed by the data this week.
Yeah, I remember when we spoke to you, I think this was sometime in September, you flagged, you underweight equities. It was about the valuation risk. We've kind of seen how it's panned out as we approach the end of the year. What is that assessment to you as an investor? Is this time to pick up a bit more tactically, or are you staying away?
I really think it's not time to chase the dips or buy the dips at the moment. I would approach the end of the year and early next year with an abundance of caution because the valuations are so stretched relative to history. There really will need to be not just good earnings growth next year, but re-acceleration in earnings growth to justify the valuations that we're seeing at the moment. And as we've come through, particularly the second half of this year and into 2026, there are just no clear signs that we're going to see that re-acceleration, whether it's in economic growth or in earnings growth. So as we're looking at equities, we look across the US, but also other major developed markets, and think that this is a time to be a little underweight equity risk, either in absolute terms or by taking lower beta exposures, just to try and provide a little bit of resilience given the eye-watering valuations that we see at the moment.
Which are the other DM equity markets that you're underweight a bit on?
Yeah, we're a little underweight the Europe, and we're underweight Australia. We've been quite diversified across our global developed market holdings and been very careful about really targeting quality and value within the equity sleeves. But overall, as we've seen this year, that diversification has really been a benefit to portfolios. But we still think that the valuations are just not compelling enough, and the outlook is just not solid enough to move back towards a neutral stance just yet.
What is the strategy for you in fixed income?
I think fixed income has been so important this year, and it's shaping up to be even more important next year as the Fed looks somewhat less certain on its policy outlook. In Australia, the RBA looks a little less certain, same with the ECB. We've really preferred to move up quality in fixed income, so that means selecting investment-grade credit and specifically short spread duration over high yield. There's been very good absolute yields on offer there. And a little bit more downside protection compared to high yield. And then in the govies space, we've really wanted to be short of duration. There's still a lot of risk as you move out the curve from sticky inflation, from the less certain pathway from the Fed, from fiscal uncertainty in the US. All of this suggests that the curve could bear steepen, and we really want to be a little bit short on the duration side there.
Isaac, I want to ask you about New Zealand as well, but hold that thought because we have some Treasury Department economic projections from New Zealand, and it's telling us that it sees slower economic growth this year and then a rebound following on from that. And the government also expects to see a later return to a budget surplus. So it's this idea that maybe the long end could continue coming under pressure globally as well. We are seeing the Kiwi against the greenback maybe firming up a little. Isaac, I wonder if you could, react. How are you expecting perhaps global debt as well, as we see a sort of hawkish turn among some of these developed market central banks?
This is a challenge because inflation really did not get under control globally, whether you're talking about Oceania with Australia and New Zealand or the US, and that's wrong-footed central banks a little bit at the moment. They've wanted to cut rates. They want to cut rates to protect the economy, but that sticky inflation is making it challenging. And then you throw into the cauldron there the fact that governments continue to spend. There's not a real clear signal anywhere, I think, in the developed markets that governments want to get their debt levels under control or their deficits under control. And that does just continue to put that upside pressure on global longer dated yields. And we've seen that in the volatility that we've had this year. We've seen that in the sell-offs we've seen over the last couple of months. And I think that's going to be something that will persist through 2026 and make that fixed income selection within portfolios really critical in a way that it probably hasn't been over the last 12 months.
Isaac, what about the moves in the dollar and gold this year? Do you also see a similar theme persisting?
I think that gold is really a risky position at the moment. We've seen non-traditional buyers really come into the gold market, and by that I mean retail buyers. Last year, or the last 18 months, as gold pushed higher, there was a lot of central bank demand. There was a lot of traditional demand in the consumer sector. But at these prices, that's starting to dissipate, and the people who are coming in to buy it are the ETFs and the mums and dads in the retail market. And we know when we look back over the last 20 or so years that gold has a habit of turning lower, and when it turns lower, it does so quickly and it does deeply. 40% falls are not at all uncommon. And I think that right now at these levels, you want to be extremely cautious with gold. There's an analog there with the US dollar. All the negative sentiment around the US dollar at the start of this year has given way to a pretty tight range for the USD. And I suspect as the Fed becomes a little less certain, there is real scope for the US dollar to strengthen up a little bit, not just at the back end of this year, but probably through the first half of next year. That was
Isaac Poole, CIO at Ascalon Capital, speaking with Bloomberg TV host Avril Hong and Sherry On here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. In the U.S. session, we had weakness in information tech shares that led much of the equity market lower. Broadcom was down by more than 5.5%. That on top of Friday's 11% decline. Now, all of that was in response to a disappointing outlook issued last week, especially when it comes to gross margins. Broadcom shares have fallen nearly 18% over the last 3 trading days. For a closer look at market action, I'm joined by Greg Halter. He is Director of Research at the Carnegie Investment Counsel. Greg is on the line from just outside Cleveland, Ohio. Greg, thanks for being here. Big tech has obviously been a major theme for so much of the year, and we've seen some de-risking from the group lately. I'm wondering whether the overall theme, especially where AI is concerned, will remain intact in 2026. What do you think?
there's been certainly some skittishness on the part of investors relative to the large companies. Oracle, if you look at their CDS, they're hitting higher levels. These companies have produced so much cash and free cash flow that there's some concern that wave may be abating a little bit, where they have to take on debt. It's really a company-specific situation, I believe. Some companies are probably more exposed than others. You're right, very interesting market, but I'd also say that, none of this stuff happens if we don't have the power, if we don't have the electricity. So that's a huge crux in the whole situation right now.
You mentioned the story on Oracle. Last week's projection on cloud revenue missed analyst forecast. The company also boosted its annual cap spending target by $15 billion. And on top of that, Oracle more than doubled its future lease commitments. So in response, we have seen, and it shouldn't come as a big surprise, Oracle's credit risk reaching a 16-year high last week. Now, I know the term price to perfection gets thrown around a lot. How does that apply in your mind?
Well, for the market as a whole, I certainly don't think so. I mean, you've got various sectors of the market that have not done much at all, like energy and healthcare. You have seen utilities perk up. Certainly for some of these companies, you need to see those numbers come through for the NVIDIAs of the world and Amazons and Microsoft. So from that perspective, yes. But I also wouldn't say that the valuations are all that crazy. Certainly not relative to what we saw in the dot-com era. So it's really a strange market.
I think it's interesting to look at the ways the Trump administration has been impacting markets. Put the tariff issue aside for the moment. I'm thinking of the move to eliminate tax credits on electric vehicles. It was just today we heard from Ford Motor, and the company is undergoing a major overhaul now to its EV strategy. So away from the auto industry, I'm interested in the other areas that you believe the administration is having an outsized effect.
Well, whenever you have a new administration, there are changes, no doubt. This one seems to be, in particular, more of a wrecking ball of sorts. Just look what's happened with the agricultural side of things and, soybean purchases from the Chinese and so forth. What Ford is saying is that they're going to convert this so they can, I think, use some of the fuel cells for batteries storage or power storage. That's very interesting. That kind of doesn't have anything to do with car manufacturing. And Tesla, if you look behind their numbers and their segments, that's probably, for Tesla, one of their fastest growing business is the whole battery storage side of things. So, behind the scenes of these companies, if you dig in, they're really not what you think they are. And Ford seems to be moving that way as well. And a lot of this is being driven by the administration. I mean, even if we get a fraction of those dollars that come here to build plants, that's huge. We haven't seen that in a long time.
We know that the administration has expressed some openness to the fintech industry as well as crypto. Today, we heard from PayPal. The company has applied to become a bank in the U.S. So talk to me about the changes that we're likely to see unfold next year when it comes to banking and financial services.
Yeah, it's a great question, and we do continue to like the banks, especially the larger banks. But if you start looking at the mid and small, they're trading at many of them at book or below book value. So good opportunities there, we think. But the change in regulations that will probably be coming and enacted here in the new year will be helpful to the banks in terms of reducing their costs. The uptake of stable coins, I think, maybe really take people by surprise at how fast this may occur. You've got these Cross River Bank and some of these others that were granted charters as well last Friday. So that whole space is changing, And maybe it's to the detriment of the rails. And when I say rails, I mean things like Visa and MasterCard, where all these payments run. Maybe that doesn't or is not as strong or solid of a business going forward, depending on how all this information and business flow with stablecoins starts to play out.
So how do you see Fed policy as a part of that story? We know that there is a move now to lower interest rates. Maybe we only get one more rate cut in the new year. Markets right now are expecting, I think, 2 quarter-point rate cuts. Talk to me a little bit about how you see the Fed influencing the market in 2026.
It's probably more theater than anything. I mean, we're talking 25 basis points or 50 basis points. Does that really make or break that many businesses? Sure, lower rates help, but if you're on the cusp of having to need 25 basis points, a lot of other things have to go well also. So again, there's a lot of theater on who's going to be the chairman, who will the members be. In the bottom line analysis, again, if you're looking at 25 or 50 basis points, that just doesn't seem to be a whole lot given where we are. And again, maybe more political theater than anything.
We've already seen some rotation away from mega cap tech names and into stocks with valuations that maybe aren't as richly priced. How much more of that trend do you expect?
Well, from the standpoint of some of the companies that have had historically high PEs, and these aren't the mega cap names, but companies like Cintas and Costco, Waste Management, Republic Services, these companies have historically had very high PEs, premium PEs, and we've actually seen those share prices, they haven't really plummeted, but they haven't really gone anywhere in the last year. And I think some of those dollars have been recycled into utilities, which have actually done fairly well. Healthcare is starting to receive a bid. Even energy, if you can believe that, with oil at 58 or whatever it is these days, starting to see some interest. So there does appear to be this rotation among sectors.
What about rotating money out of the United States?
We at Carnegie are not big fans of international investing. We probably have not had much in the way of international exposure overall for 10 plus years. Frankly, until this year, it's been a good move. We believe it's hard enough to keep track of companies and their businesses and their accounting in the U.S., let alone go outside the U.S. and try and make sure that the accounting and other rules and regulations are up to snuff. Our system here in the U.S. has its faults, but we know what they are, at least.
Are you fully invested right now? Maybe you're holding on to a bit of dry powder in anticipation of some sort of pullback.
Hard to blanket answer that question because we have about 20 separate portfolio managers here. But if I had to put a blanket statement on that, I would say we are probably pretty well invested, mainly in equities, certainly some individual bonds, and the cash holdings have been really kept to a minimum for a couple of years now.
Okay, Greg, we'll leave it there. Thank you so much. Greg Halter is the Director of Research at the Carnegie Investment Counsel, joining us from just outside Cleveland, Ohio, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.